Welcome to vTalkInsight, Market Drivers Daily for January 9th, 2026. Geopolitics, artificial intelligence, and fiscal policy are colliding again, and markets are reassessing risk across defense, energy, and big tech. Let's start with how today's geopolitical tension is moving prices and risk premia. Geopolitics remains a core macro driver, but the transmission into markets is increasingly specific rather than broad-based. The key channels today are U.S. policy toward Venezuelan oil, shifting defense budgets, and the growing use of sanctions and crypto to project power, all of which are reshaping risk premia in energy, defense, emerging markets, and parts of financials. In Venezuela, Washington now plans to control crude sales and hold proceeds in U.S. accounts, signaling a move from traditional sanctions toward direct management of cash flows. The strategic aim is regional dominance in the Western Hemisphere, keeping foreign powers out and channeling barrels toward Gulf Coast refiners, even if that means restricting exports to the United States only. At the same time, seizures of Venezuelan cargoes and tighter enforcement on sanctioned shipping are disrupting flows to China and others, adding another layer of volatility to global energy trade. Despite the policy drama, the supply story is more muted. Venezuelan output is unlikely to rebound quickly. Infrastructure is degraded, break-even costs are high, and major oil companies want strong legal and security guarantees before committing capital, especially with over $30 billion of expropriation claims still unresolved. Analysts expect that without a credible political transition and commitment to free and fair elections, foreign investment will stay limited, keeping production growth slow and leaving global oil still broadly oversupplied in the near term. Defense spending is the other big geopolitical transmission channel. Proposals from President Trump to lift the U.S. military budget by around 50% toward $1.5 trillion and to redirect contractor cash from buybacks and dividends into production have triggered sharp rallies in defense stocks worldwide, especially in Europe. European defense names are now trading more on expectations of sustained top-line growth from rearmament and higher budgets, rather than on dividend yield alone, as markets price in a potential multi-year fiscal tailwind. Financial sanctions are also evolving. Illicit crypto flows hit a record, with over $150 billion in 2025 and stablecoins accounting for the vast majority of that volume, as sanctioned states use digital assets to bypass traditional channels. Russia has processed tens of billions through a ruble-backed stablecoin, prompting the U.S., UK, and EU to target specific wallets and instruments, while regulators increase scrutiny of prediction markets and other venues that might be used around military or political events. The expectation is that crypto-enabled sanctions evasion will remain a growing, professionally run activity, keeping compliance and reputational risk elevated for exposed firms. There are important offsets to these risks. Oil prices have been relatively contained thanks to broader oversupply and alternative sanctioned barrels, helping emerging markets keep inflation under control and allowing central bank easing cycles to continue. U.S. moves to assert influence in Greenland and Venezuela also face institutional checks, with Senate approval required for major treaties, congressional oversight for prolonged military action, and public resistance to more aggressive policies. History shows that markets often treat geopolitical headlines as short-lived risk-off shocks unless they crystallize into concrete policy shifts, so investors are watching follow through rather than rhetoric alone. Looking ahead, the main watch points are how far U.S. control over Venezuelan export proceeds extends, whether ship seizures escalate, and how quickly restructuring of Venezuelan sovereign debt progresses. On the defense side, the gap between proposed and legislated budgets will matter for valuations in both U.S. and European contractors, given fiscal constraints in countries such as France and the UK. Finally, the evolution of crypto sanctions regimes will shape the operating environment for exchanges, banks, and payment platforms exposed to cross-border flows. With that backdrop, it is natural to turn to artificial intelligence, which is increasingly intertwined with both geopolitics and growth expectations. Artificial intelligence remains the main equity and growth narrative, but the cycle is clearly maturing. The U.S. government now attributes more than one-third of current GDP growth to the AI boom and is actively coordinating with the private sector to cement AI leadership, while investors reassess which parts of the value chain can sustain that momentum. That shift is moving the market from a broad tech rally toward a more discriminating regime with clearer winners and losers. Market performance is heavily tied to AI infrastructure. Most of the expected U.S. equity growth in 2025 is linked to AI data center investment. So any slowdown in CapEx would quickly feed into both macro data and S&P 500 earnings. Hyperscalers are facing enormous capital needs, estimated at $5 to $7 trillion over the next 5 to 6 years, which could lift their share of investment-grade issuance into the low double digits and put new strains on credit markets. At the same time, large inflows into AI-related private credit raise bubble concerns, as competition for these deals may erode underwriting discipline. Leadership within AI is already rotating. The narrative is moving toward core hardware, with investors expecting the next phase to favor chip and equipment makers in Korea and China, as well as select European semiconductor and capital goods firms, which have clearer earnings visibility as AI adoption spreads into sectors like banking. Samsung's strong preliminary results, driven by AI-related demand and higher memory prices, underline that shift, while dedicated AI funds and indices continue to see sizable inflows that concentrate exposure in perceived infrastructure winners. Within U.S. big tech, the picture is nuanced. Street forecasts for Microsoft's cloud and AI businesses may still be conservative, with some seeing room for upside in both revenue and cash flow as enterprise use of AI accelerates over the next 3 to 5 years. Apple, by contrast, is entering a critical phase. It is expected to embed AI across a vast installed base of more than 1 billion iPhones and billions of iOS devices, yet faces questions about limited near-term AI product exposure, rising memory costs, and heavy dependence on China for both revenue and manufacturing. Investors are also watching OpenAI's execution, because any stumble could dent confidence in the broader AI growth story that underpins big tech valuations. The real economy footprint of AI is widening. Demand for copper is projected to rise by around 50% by 2040, helped by electrification, data center build-out, and defense needs linked to AI-enabled systems. Data centers are also driving unprecedented demand for reliable on-site power, as grid capacity alone is unlikely to keep up, tying AI directly into the energy transition narrative. In healthcare, AI is accelerating work on gene therapies and treatments for rare diseases, while in financials, early adopters such as trust banks are beginning to see operating leverage and a more favorable earnings outlook. There are, however, meaningful risks building around this theme. Rapid AI adoption complicates central bank policy, as structural changes in labor markets make it harder to read jobs data, and periods of intense technological investment tend to be inflationary rather than disinflationary. Return on invested capital for large AI infrastructure projects is uncertain. Late-stage private valuations are stretched, and the AI-driven rally appears to be shifting away from speculative fringe names toward a narrower group of core platforms. Geopolitics adds another layer, with NVIDIA navigating restricted H200 chip sales into China, new coalitions such as Pax Silica seeking to reduce reliance on Chinese supply chains, and ongoing export controls keeping market access conditional. Looking forward, the key question is whether AI-driven productivity gains broaden beyond technology into the wider corporate sector. If adoption spreads across industries, the current concentration of equity leadership in a handful of megacaps could give way to a wider set of beneficiaries, supporting the soft landing narrative and keeping recession probabilities closer to the lower end of current estimates. Conversely, if data center investment slows, OpenAI or other key platforms disappoint, or credit markets tire of funding multi-trillion-dollar capex plans, the earnings and valuation case for AI-heavy benchmarks would look more fragile. Against that backdrop, fiscal policy is becoming an increasingly important second engine for growth and a key variable for how the AI and geopolitical stories feed into markets. Fiscal policy is providing a powerful tailwind to growth into 2026, even as political and deficit concerns start to surface. Globally, a positive fiscal impulse in Europe and Asia is supporting a rotation into cyclical laggards, such as basic resources and oil, while in China, targeted measures to revive subdued consumer demand and support technology and export sectors underpin a more constructive view on local equities. In the United States, multiple forces including lower oil prices, a softer dollar, and new spending plans are making bearish macro calls harder to sustain. The U.S. fiscal stance increasingly resembles a run-it-hot strategy. Substantial stimulus is expected from tax cuts, lower withholding, and corporate tax reductions in early 2025, and a Supreme Court ruling that limits tariff authority could act as additional stimulus by lowering or refunding duties to importers. On top of that, the administration is signaling a willingness to push defense spending sharply higher, with proposals for a 50% increase in the military budget to around $1.5 trillion, which has already sparked large pre-market moves in defense equities. Domestic policy is also targeting housing and healthcare. Efforts to address housing affordability are skewing toward supply-side measures, such as subsidized mortgages, streamlined permitting, zoning reform, and ideas to use the tax code to offset mortgage rate lock-in, with estimates that government action on fees and tariffs could shave up to 60 basis points off borrowing costs and reduce construction expenses by several $1,000s per home. Maryland's push for more housing through transit-oriented development and density bonuses reflects this emphasis on expanding inventory rather than imposing price caps. Meanwhile, extensions of Affordable Care Act tax credits, which have cleared the House and are under negotiation in the Senate, would keep premium subsidies flowing for millions, with direct implications for health insurers and household disposable income. Bond markets, however, remain skeptical that the most aggressive spending plans will fully materialize. Yields have stayed relatively calm despite proposals for massive defense outlays, in part because investors doubt Congress will sign off on the full increase, and because questions persist about affordability and strategic relevance, given evolving warfare technologies and lessons from conflicts such as Ukraine. There is also concern that growing government intervention in sectors like housing and energy could dampen market-driven innovation and crowd out private capital, especially if wage and inflation pressures on lower-income households translate into more intrusive regulation. For markets, this mix of generous but contested fiscal policy creates a two-way backdrop. On one hand, ongoing stimulus supports growth, earnings, and risk assets, and reduces the near-term need for aggressive Federal Reserve rate cuts. On the other, the possibility that large defense and social spending packages do pass keeps medium-term deficit and inflation risks alive, with implications for term premia, currency dynamics, and how durable today's equity multiples prove to be. The main watch points are the legislative path of the U.S. defense budget, tax and tariff decisions, housing and healthcare bills, and the scale of fiscal packages in Europe and Asia, all of which will help determine whether the current run-at-hot environment persists or gives way to a renewed focus on consolidation. Across markets, three forces are doing the heavy lifting today. Geopolitical tension is being expressed through Venezuelan oil policy, defense budgets, and sanctions innovation, with selective but meaningful impacts on energy, credit, and defense equities. The AI cycle remains a dominant growth engine, yet is moving into a more demanding phase where infrastructure, hardware, and real economy applications drive dispersion and magnify both upside and downside scenarios. And a broad fiscal push, especially in the United States, Europe, and Asia, is supporting a run-at-hot backdrop, even as questions about deficits, policy intervention, and long-term inflation build. Watching how these three narratives interact around upcoming policy decisions, earnings, and capital spending plans will be key for understanding the next leg of cross-asset performance. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.